Okay, so you want to own an Applebee's. You've seen them everywhere. Strip malls, highway exits, downtown corners. A brand everyone already recognizes. A menu that's been tested on 100 million customers. A proven system. A real support network. It sounds like the closest thing to a guaranteed business. It is not what you think it is. The average Applebee's does $2,640,000 in annual revenue. The average franchisee takes home $120,000. That's not a typo. On $2.6 million in sales, you keep less than 5 cents on every dollar. And there's something Applebee's doesn't put in the brochure. The contract you sign is 20 years long. They can open another location 6 miles from yours. They can change the menu, raise your fees, redesign your restaurant, and there is nothing in those 20 years that lets you say no. By the end of this video, you will understand what it actually costs to get inside this system, where every one of those $2.6 million actually goes, and why the franchisee's making real money. Figured out something the contract never tells you. Let's start with who owns what, because it's not who you think. Applebee's is the largest casual dining chain in the world. More than 1,500 locations across the United States. $4.25 billion in system-wide sales last year. That number is real. What it costs to get a piece of it is also, and it's probably not what you're imagining. The total investment to open a single Applebee's franchise runs between $1,766,798 and $5,822,933. That range depends on whether you're converting an existing space or building from scratch. Converting sounds like the cheaper path. You still got most of the interior to match Applebee's exact specification. The savings are real. They're just smaller than people expect. Most realistic build-outs land between $3,870,004 and $5,822,933. The midpoint of that range is $4,846,469. That's where the math starts. Here's how that breaks. The largest cost is construction and build-out. An Applebee's is not a small operation. You need a full commercial kitchen, built to serve a 130-seat dining room at peak volume. A bar with a full liquor license, plus the infrastructure to support it. A dining room built to exact corporate specifications. Layout, signage, lighting, booths, TV placement, all dictated for you. Every inch gets approved by Dine Brands before you open. You don't design a restaurant. You execute a blueprint. Then there's insurance. General liability, property, liquor liability, workers' compensation. $20,000 to $40,000 a year just to keep the doors legally open. Then there's the franchise. $35,000. Paid up front, non-refundable. That buys you the right to use the name, not the right to run it how you want. Training and pre-opening expenses run another $75,000 to $120,000. That covers management training at a corporate facility, pre-opening staff preparation, and 8 days of on-site support before you open. 8 days in. Then there's working capital, the cash you need in the bank before you open, enough to cover operations while your location builds a customer. Applebee's doesn't specify exactly how much, but they do specify this. To even apply, you need a minimum net worth of $2,500,000 and $500,000 in liquid assets per location you intend to open. Per location. And almost none of that $4,846,469 comes from your own pocket. Most franchisees finance it. SBA loans, conventional bank debt, sometimes both. Every one of those loans gets personally guaranteed. If the restaurant fails, the debt doesn't stay with the business. It follows you. Applebee's isn't looking for someone with a dream and a business plan. They explicitly want experienced, multi-unit restaurant operators, people who already run full-service dining at scale. People who, in their own language, are probably already operating restaurants with another brand. If you've never run a restaurant, you are not their target franchisee. If you've run one restaurant, you're still probably not their target franchise. And there's one more thing nobody highlights in the franchise pitch. Applebee's does not offer financing. They do not guarantee your lease. They do not co-sign your loan. Every dollar of risk sits on your side of the table. They take the name back if it doesn't work out. Now you might be thinking, okay, $4,846,469 is steep, but the average location does $2,640,000 in revenue. That number is real. But here's what nobody tells you before you sign. That number is not yours. Most of it was already spoken for before your first customer walked through the door. And the entity collecting it, it's not on your payroll, and it doesn't show up on your org chart. And it gets paid first, every single week. Before you do, how the money flows, your restaurant is open, customers are coming in, our drinks are being poured, riblets are leaving the kitchen. The average Applebee's does $2,640,000 in annual sales, and that's $50,769 a week. Here's what happens to every dollar of it. Before you pay a single employee, before you buy a single case of food, before you pay the first month's rent, 8.25 cents out of every dollar leaves. It goes straight to Dine Brands Global. 4% is the royalty fee. 4.25% is the National Advertising Fund contribution. Both fees are calculated on your gross sales, not your profit, not your net, not what's left after your costs. Your gross. Every dollar that clears the register. Both are due every single week. On $2,640,000 in annual revenue, that's $217,800 to Dine Brands, before you've paid for a single thing else. Now the rest. The menu itself isn't cheap to run either. Applebee's carries dozens of items across apps, entrees, and value deals. More items mean more ingredients, more prep, more waste on what doesn't sell. Food cost in full-service dining runs 28% to 32% of sales. That covers every protein, every vegetable, every sauce, every roll, every cocktail, and everything that leaves your kitchen and arrives on someone's table. And at 30%, that's $792,000 a year in ingredients. Labor is where the picture shifts. Full-service labor covers servers, bartenders, hosts, cooks, dishwashers, managers. In a tightly run operation, that's 35% of sales. At 35%, that's $924,000 a year in wages, before a single hour of overtime. Before benefits, the National Restaurant Association tracked this in 2025. Median labor cost for full-service operators, 36.5% of sales, not 35%, 36.5%. Restaurant turnover in full-service dining runs 70% to 100% a year. Every time someone quits, you hire and retrain. That's a cost the disclosure paperwork never itemizes. Occupancy, your lease, property taxes, common area fees, runs 10% of sales in a well-sited location. That's $264,000. Utilities, insurance, supplies, repairs, plus the equipment that breaks at the worst possible time, add another $150,000. Credit card processing alone eats 2% to 3% of every transaction. On $2,640,000 in sales, that's $52,800 to $79,200, already folded into that $150,000. Gone before a single light bulb gets replaced. Let's close the loop. Revenue, $2,640,000. Dine Brands fees, $217,800. Food, $792,000. Labor, $924,000. Occupancy, $264,000. Everything else, $150,000. Total out, $2,347,800. What remains? $292,200 before taxes, before debt service on your $4,846,469 bill, before your own salary. Franchise Business Review tracked actual take-home pay for franchisees who'd been operating at least 2 years, $120,000 on a $4,846,469 investment. 2.47% annual return. A 10-year U.S. Treasury bond currently yields more than that. With no employees to schedule, manage, or chase down on a Saturday night. With no equipment to fix at 6 p.m. on a Friday. But that's not even the real problem, because those numbers assume you saw every cost coming. You didn't. There's one line item that never appears in the franchise disclosure document, never gets mentioned in the pitch meeting, never shows up on any spreadsheet you'll build before you sign. And it's been draining franchisees since the day the brand was created. The hidden costs. There's an entity in this business that collects no matter what. Whether your dining room is packed Friday or empty Tuesday. Whether you ran a record quarter or your worst one. Whether beef prices spiked and crushed your food cost. Or a slow winter cut your covers in half. That entity is Dine Brands Global. Dine Brands does to Applebee's franchisees what oil companies do to gas station owners. They sit at the top of every transaction. They collect their percentage first. Then whatever is left is yours to fight over. Here's the part most franchisees never model before they sign. That 4.25% National Advertising Fund contribution you pay every week, you fund it. Dine Brands controls it entirely. They decide the creative direction. They decide which promotions run nationally. They decide the value deals on every table, including yours. In 2024, Applebee's pushed the 2 for $25 promotion and the really big meal deal at $9.99. Those deals brought people through the door. They also compressed your margin on every cover that ordered them. You paid into the campaign through the ad fund. You took the margin hit when the discounted orders came in. Both events were driven by corporate. You executed on their behalf and absorbed the financial consequences. That is the structure of the relationship. Then there are mandatory remodels. Applebee's has been rolling out its Looking Good renovation program. Over 100 locations updated already, with more scheduled every quarter. If your restaurant gets flagged for renovation, you renovate on your budget, on their timeline. At the specification level, they require a full remodel costs real money, 6 figures, sometimes well past it. You don't schedule it, you don't negotiate the scope, you get notified and you execute. Here's the clause most people don't read carefully enough. Per the agreement, Applebee's can raise the royalty rate above the current 4% floor. You signed a 20-year agreement. That is a very long time for a contractual ceiling to shift. There's also the territory problem. Applebee's does not grant exclusive territories to its franchisees. If Dine-in Brands wants to place another franchise nearby, or even a company-owned location, they're fully permitted to. You cannot block it! You cannot negotiate compensation for the lost traffic. The market you analyzed in your business plan can look completely different once a second Applebee's opens 6 miles away. And then there's the customer base problem. It never shows up in any cost breakdown, but it shapes every revenue projection you'll ever build. 2/3 of Applebee's customers earn less than $75,000 a year, and that is the demographic the brand was designed to serve. It's also the demographic that cuts dining out first, the moment inflation tightens household budgets. In the fourth quarter of 2024, Applebee's domestic same-store sales fell 4.7%. For the full year, they were down more than 5%. Total system-wide sales dropped from $4.5 billion in 2023 to $4.25 billion in 2024. The system contracted to 1,642 locations at the end of 2023, 1,614 by the end of 2024, 1,567 by the end of 2025. A shrinking system means lower advertising scale, fewer locations building brand awareness, more pressure on a consumer who was already pulling back. You didn't choose that customer, the brand chose them for you when it was built, and your 8.25% weekly fee doesn't change, not even when they decide to eat at home instead. Most franchisees understand all of this by year 2 or 3. By then the lease is running, the loan is drawn, and there's a moment, usually quiet, usually late, where they finally read the agreement carefully and realized they misunderstood something fundamental. Not about the fees, not about the margins, about what they actually bought. Most people who buy an Applebee's believe they're buying a restaurant, a neighborhood institution, a business they can shape, something they own. They don't. Here is what an Applebee's franchise actually is. You are not a restaurant owner. You are a licensed operator. Dine Brands owns the brand, the systems, the recipes, the playbook. They license all of it to you. In exchange, you build the restaurant. You hire and manage the staff. You absorb the capital risk. You service the debt. And you pay them 8.25% of every dollar you ever bring in. Forever. Every riblet. Every $2 cocktail special. Every 2 for $25 table. Dine Brands receives their 8.25 cents before you pay your electricity bill. The restaurant isn't working for you. You are working for the restaurant! And the restaurant is working for Dine Brands. Most franchisees don't fully see that structure before they sign. They focus on operations. Staff management, customer service scores, kitchen efficiency, all of that matters. None of it changes the underlying arrangement. You are a contractor executing on someone else's system. The first party to get paid in every transaction is not you. That reality becomes impossible to ignore once you see what happens to franchisees who can't sustain it. In March 2025, Dine Brands took direct control of 47 restaurants from 2 franchisees who were underperforming. They called it an operational move, a chance to remodel and improve performance before refranchising in 3 years. That's one way to describe it. Another way, a licensor reclaiming assets when the operator couldn't keep up. Then in March 2026, a group called Neighborhood Restaurant Partners filed for Chapter 11. They were an Atlanta-based operator. 53 Applebee's locations across Florida, Georgia, and Alabama. Their liabilities ran between $10 million and $50 million. They owed more than $13 million to a single lender, Equity Bank. They'd already closed 9 restaurants in 2025, 5 more in early 2026, trying to stabilize. They spent months searching for a buyer. 17 different investor groups evaluated the portfolio. Not one made an offer. Dine Brands stepped in as the lead bidder in the bankruptcy sale. The restaurants, the leases, the agreements, all expected to transfer back to the parent company. A licensor recovering assets from a struggling licensee is not a rescue. It is the contract doing exactly what it was written to do. The brand doesn't need its franchisees to get rich. It needs them to operate. As long as the doors are open, Dine Brands collects. Whether you're thriving or barely holding on makes no difference to the fee. That is the business, and that is a trap! But it's not the whole story, because somewhere inside this same system, the same fees, the same menu, the same 8.25%, one person cracked it completely. He didn't fight the structure. He didn't renegotiate the contract. He didn't find a loophole. He just understood something about this business that almost nobody else saw, and it made him a billionaire who actually makes money. His name is Greg Flynn, and he didn't stumble into this. He looked at the same numbers you just saw. The 3% return, the fixed fees, the 20-year agreement, and saw something completely different. Not a trap, a blueprint. In 1994, Greg Flynn graduated from Stanford Business School. His classmates went into tech. The dot-com boom was accelerating. Silicon Valley was the obvious destination. Flynn went to Seattle and started a real estate business. He also backed a restaurant concept called World Wraps, a classmate's idea, a wrap-based fast casual chain. It opened its first location in San Francisco, February 1995, with lines around the block. Flynn built 14 locations in Seattle. Then the concept collapsed. And in that failure, he saw something important. A startup restaurant concept carried enormous risk with no floor. A proven brand, 44 years of history, 1,500 locations, was a completely different kind of asset. In 1999, he cold-called the owner of an Applebee's franchise group. He bought 8 restaurants in Seattle for $14 million, financed through Goldman Sachs. Non-recourse, meaning if it failed, they couldn't touch anything else he owned. 2 years later, he bought 62 more. Applebee's grew nervous. That much concentration could tip the balance of power. Operator versus brand, they capped Flynn at 11% of all Applebee's locations system-wide. Then in 2007, IHOP purchased Applebee's and needed to raise capital quickly. They lifted the cap. They began selling Flynn company-owned locations at discounted prices. When the Great Recession hit, smaller franchisees started selling distressed units. Flynn was buying. Average acquisition cost $500,000 per restaurant. Average cost to build one from the ground up, $1,800,000. He was buying $1,800,000 assets for $500,000 because he had the capital, the patience, and the operational infrastructure to hold them through the recovery. Today, Flynn Group owns more than 450 Applebee's restaurants across 23 states. His full portfolio spans Applebee's, Taco Bell, Panera, Arby's, Pizza Hut, Wendy's, and Planet Fitness, combined over $5 billion in annual revenue. In 2026, the International Franchise Association inducted him into their Hall of Fame. He's reportedly the first person in franchising history to reach billionaire status as a franchisee. 4 patterns separate what Flynn built, from everything that bankrupted neighborhood restaurant partners and everyone else who couldn't sustain the model. First, scale changes the math entirely. The economics of a single Applebee's are marginal at best. The economics of 450 are transformative. Fixed overhead spreads across hundreds of locations. Supplier negotiations shift dramatically in your favor at volume. The management layer that eats into a single owner's margin becomes a fraction of a percent spread across hundreds of units. Second, entry price determines return. Flynn didn't pay $4,846,469 to build a restaurant from scratch. He paid $500,000 for one already operating, staff in place, equipment installed, customers already coming in. The return on $500,000 at the same $120,000 net per unit is 24%. Same brand, same fees, same menu. The acquisition price is the only variable that changed. Third, treat it as a portfolio, not a restaurant. Flynn employs economists and data scientists to optimize his menu strategy. The single-unit franchisee makes those decisions with a spreadsheet. The difference in decision quality compounds over time. Fourth, survive the cycles with patience and capital. Every downturn that forced smaller operators to sell was a buying opportunity for Flynn. He is still there after 25 years. Most franchisees who sold to him during hard times are not. 2 completely different paths through the same brand, same fees, same menu, same riblets. One path breaks franchisees. One path built a billionaire. The only difference isn't luck, it isn't connections, it isn't even skill. It's one number. And once you see it, you can't unsee it. That number is your entry price. Everything else, the fees, the food costs, the labor, the royalty, stays exactly the same. But change what you paid to get in, and the entire business transforms. Here's what that looks like in real numbers. 2 scenarios, real numbers. Scenario 1. You're a well-capitalized first-time Applebee's franchisee. You build a single location from scratch in a solid suburban market. $846,469. Annual revenue comes in at the system average $2,640,000. Dine Brands royalty at 4%, $105,600. National ad fund at 4.25%, $112,200. Combined, $217,800 off the top before you run a single operational expense. Food at 30%, $792,000. Labor at 35%, $924,000. Occupancy at 10%, $264,000. Utilities, insurance, maintenance, supplies, $150,000. Net before debt service and taxes, $292,200. After taxes and debt service on your $4,846,469 build, your annual take-home $120,000, return on a $4,846,469 investment, 2.47%. Estimated payback period between 22.1 and 24.1 years. You'll work full restaurant hours for 2 decades, just to get your own money back. And that's the scenario where everything goes right. Drop your revenue 10% below system average, a slow year, a new competitor, a recession. That $120,000 take-home doesn't shrink gently. It evaporates because almost every cost above it is fixed. The rent doesn't drop, the royalty doesn't drop, the loan payment doesn't drop, only your number does. Scenario 2, you're Greg Flynn in 2009. The economy has collapsed. A franchisee in your market is bleeding out and needs to sell. You acquire 10 Applebee's locations at $500,000 each. Total investment across 10 units, $5 million. Each location generates the same $2,640,000 in annual revenue. Same fees, same costs, same $120,000 net per unit. But your acquisition cost was $500,000, not $4,846,469. Annual net per unit as a percentage of your entry price, 24%. Across 10 units, that's $1,200,000 a year on a $5 million investment. Same brand, same menu, same customers ordering the same riblets. The math changed because the entry price changed. That one variable, what you paid to get in, is the difference between a business that breaks franchisees and a business that builds a billionaire. 10 units built from scratch at $4,846,469 each would run $48,464,690. Say Flynn got the same $1,200,000 a year for $5 million. Same restaurants, same riblets, a fraction of the price. The restaurant is the same. The deal is completely different. Applebee's has fed America for 44 years. It survived the casual dining wars of the 1990s. It survived the rise of fast casual. It survived the pandemic. It is still open tonight in 1,567 locations across the country. The brand is real, the customer base is real, and the revenue is real. But the business you think you're buying, when you see that green and red logo on a strip mall, is not the business described in the franchise agreement. The franchise agreement describes a licensing arrangement. Dine Brands owns the brand, the systems, the recipes, and the playbook. You build the restaurant and you manage the staff. You service the debt. You carry the operational risk. They collect 8.25% of your gross every single week, regardless of how your month is going. For 20 years. The people who make serious money here don't run a neighborhood grill. They acquire distressed assets at a fraction of build cost by spreading fixed overhead across dozens of units until the marginal cost of each new location approaches zero. By treating Applebee's the way Greg Flynn treated it, not as a restaurant, as a scalable infrastructure business. Built on top of a brand he didn't have to create. Most franchisees never get there. They go in thinking about booths, riblet orders, happy hour traffic. They figure out the real structure around year 2 or 3. By then, the 20-year lease is running. The $4,846,469 build cost is a personal guarantee on your balance sheet. The 8.25% is already flowing every single week. The ones who thrive aren't the ones who ran the best restaurant. They're the ones who understood it early and had the capital to act on it. They were never in the restaurant business to begin with. They were always in the licensing business. Dine Brands is the licensor, you are the operator. And in a licensing deal, only one side is guaranteed to get paid. 44 years of advertising taught everyone the slogan that almost nobody reads the agreement that comes with it. Eating good in the neighborhood. The question is whether you're the one eating well or just serving it.